الحمد لله رب العالمين والصلاة والسلام على النبي الأمين وعلى آله وصحبه أجمعين. Dear brothers and sisters, Assalamu alaikum wa rahmatullahi wa barakatuh. Inshallah, today I'll be talking about an of what is Islamic financial system, what is the rationale behind the development of Islamic finance or the financial systems. Talk about the major prohibition of Sharia and what is the Sharia and its ultimate objective, and I will give you an overview of what is the Islamic financial market as well as the institutions. So here are the chapter contents where I'll be talking on what is Islamic financial system, what is Sharia, and then the prohibited elements in Islamic finance, the major prohibitions, and then we'll talk about the functions of Islamic financial system, the types of Islamic financial markets, Islamic financial intermediaries or institutions, we can say, and the requisite of Islamic financial system means what are the things needed, which are must for the well operation of an Islamic financial system. So, in order to understand the Islamic financial system, let us go back to the definition of the financial system. As we understand, a financial system is a collection of markets, institutions, laws, regulations, and techniques that operate to enable the transfer of money from the surplus side or savers to the deficit side or borrowers. As we know, in our economy, there are two sides. One is the surplus side or surplus unit, another one is the deficit unit, and in that financial system, the financial market or institutions, they work as the intermediary. So here is the figure of a financial system, where in my left hand side there are surplus unit, which are usually households, firms, governments, or foreigners, those who have surplus amount of money, so they need to invest their money to get some return, or they need to keep their money for safekeeping for some times. And at the same time, at my right hand side, there are also some households, farms, or even the governments or foreigners. They need financing, they need funds in order to extend their business, or for governments to develop some infrastructure, or in some cases to fulfill the operating costs or give salaries. Or in some cases, some foreign companies, they need funding to expand their businesses, or some corporations, business firms, they need fund to sometimes to pay their salary, or to extend their business, or to increase their working capital. So the surplus units, they sometimes directly meet the deficit unit, and if that happens through the financial markets. It can happen through the money market or capital market. So that is the direct financial intermediation. But in some cases, there are some intermediaries that between the surplus and deficit unit, and those intermediaries are mostly the financial institutions like banks or credit institutions. So the surplus unit, they will put their money in the bank, and bank may give and then bank may promise to give them some return, and then at the same time, the deficit unit will approach the bank, and they will take some loan or credit to fulfill their needs. So a financial system is all about it. A system is where which involves the market, the financial institution, but at the same time it needs laws. So to make sure the deficit units, when they borrow, they pay back. So there should be a good system. There should be a legal support, governance, as well as monitoring and regulation. So all of these components, all of these are the components of a financial system. So if we look so from that figure, we can conclude that in a financial system, there is a financial market where the surplus unit and deficit unit, they meet together without any intermediary. Sometimes they meet through the financial institution. So a financial system incorporates financial markets, financial institutions, as well as financial instruments. When the deficit unit, they take funds from the surplus unit, there are some ways and procedures, like through one of the example is through the issuance of bonds. So the deficit unit, the firm, for example, or the government, for example, one needs fund, and they can issue bonds, or in case of Islamic finance, they may issue sukuk, and then through that they can collect fund from the surplus unit. So this sukuk or bond is a financial instrument. So similarly, there are Islamic money market instruments or shares, as well as Islamic banks or conventional banks. They have some products like home financing or car financing. So all these are the financial instruments. At the same time, in order for the financial system to be safe, and in order to make sure or to minimize the risk of the surplus unit, so that they can get back the return or what they have loaned. So there needs a robust system, and there should be a regulatory agency to monitor and to supervise. In the case of Malaysia, like Bank Negara, the central bank plays the role of the regulatory agency, as well as the Securities Commission also is one of the regulatory agencies. So all these are the parts of the financial system. So now when you understand the conventional financial system, so come back to Islamic financial system. So when we come to Islamic financial system, here we have two things. One is Islamic, another one is finance. So as the first the noun, at first let's look at the finance. Okay, the noun finance suggests that Islamic finance basically deals with allocation, management, and acquisition of resources and investment. So the word finance means that Islamic finance is expected to do the same like the conventional finance, or the traditional finance is about the intermediate, about the transformation of the risk, as well as the management of the funds, the intermediation of funds between the surplus unit to the deficit unit. So the Islamic finance are expected, or at least do the similar, or fulfill the similar objectives. But when we talk about Islam, okay, the adjective Islam implies that some fundamental differences, means that Islamic finance will fulfill the same objective of the conventional finance, but in a way or in a mechanism that is not against the Sharia, that fulfills the principles of Sharia, following the rules and regulation of Sharia. Sharia is the Islamic law. So Islamic finance is built upon a number of distinctive and unique characteristics. So because it follows a Sharia principle, Sharia rules and regulation, so it has some distinctive features, some unique characteristics. What are those characteristics? For example, in Islamic financial system, the interest is prohibited, and that makes a major difference between Islamic and conventional financial system. And then there is prohibition on cheating or speculation, or excessive speculation, gambling, monopoly, and also the trading of non-halal goods. At the same time, Islamic finance introduces mutual cooperation, profit and loss sharing between the deficit and surplus unit, for example, to achieve communal prosperity. At the same time, Islamic finance also prescribes almsgiving, like zakat, which is a compulsory payment that the people with the required amount of wealth, they are required to pay. So these are the unique features or the differences that Islamic finance makes to the along with fulfilling the conventional or traditional objective of finance. So we can conclude from that the Islamic finance or Islamic financial system is a financial system that is based on Islamic principles and values, which eliminates a riba or interest and ensure a profit sharing mechanism in the financial system. So Islamic finance is something that's objective is to eliminate riba in the financial system, as well as to encourage or to ensure profit sharing, profit and loss sharing among the parties, among the banks and the clients, or among the issuer of financial securities and the purchasers or the participants of any financial instrument. So Islamic finance is the objective also to fulfill the conventional system in a way that to do the intermediation to proceed the fund from the surplus unit to the deficit unit, but with the condition that there is no riba or interest. The surplus unit cannot just receive their income from interest. Rather, it promotes profit and loss sharing. Means the deficit unit who get the fund, they will do business, or they will invest, or they will develop infrastructure, and then if there is a return, so that return will be shared between the funder as well as the entrepreneur. So that is what is the basic concept of Islamic financial system. So now we can, based on the discussion, we can conclude some of the unique features or characteristics of Islamic finance. So in Islamic finance, money is as a potential capital. So money is something that has a potential to get a return, but through business or through buying and selling, through trading. So money itself is not it does not guarantee a return. Rather, the money should be invested, the money should be used to buy commodities or to trade, so that there will be a return from it. So in Islamic finance, money is not a commodity, means that money itself cannot give us a return, a fixed return. Rather, the money is used to invest or to trade, and then we'll get return from that trade. And in Islamic finance, because there is no interest, there is no riba, so there is always an akad or contract in every financial product. So in order to have risk sharing, there will be like mudaraba or murabaha, profit and loss sharing, or maybe there will be ijara, lease, or there will be sale, even like by murabaha. So all these are the contracts in every Islamic financial products that Islamic banks they offer, or or any securities like sukuk, or Islamic money market instrument. All of these have an underlying contract and akad. So that will be means that will lead the the participants to either share profit and loss or to trade, to buy and sell. So another important one is Islamic the financing is based on real economic activity. So whatever the return comes in Islamic finance is not out of nothing, rather is based on real economic activities. It's based on the return from the business, is based on the trading, real buying and selling. When we sell an asset, there is profit from that sale, so that is the gain in Islamic finance. So unlike the conventional where the gain is sometimes it can be out of nothing because it's based on the interest, and that interest may not add value to the economy. It may the creditor is gaining profit through the interest, and that interest is may not come or may not add anything new to the economy in terms of assets or in terms of goods. But in Islamic finance is based on the real economic activities. So the profit we get is from the business or from buying and selling. So the very important characteristics in Islamic finance is risk sharing, profit and loss. And that is one of the Islamic legal maxim. It says that al-gunmu bil gurum, that profit comes with a liability. So if there is a profit, at the same time there is a possibility of loss as well. So if someone is doing musharaka business, profit and loss sharing business, so if there is a profit, the profit will be shared, and if there is a loss, the loss also will be borne by both of the parties. So the very ultimate, the heart of Islamic finance is that the profit and loss between the parties are shared. Of course, in some cases, there are different types of investors. They may not choose a different, they may not choose the risky assets, which are very risky to share profit and loss. They may go for a lower risky asset, but even in those assets, there is also some kind of risk sharing, and because there is buying and selling, or maybe there is lease. So lease-based assets, maybe they have lower risk compared, because the return from the lease, the rental income is quite stable comparing with musharaka investment, for example, where the profit fluctuates a lot. So there are may have the level of risk, but there is always an element of risk sharing in Islamic finance. And then in Islamic finance, in order to make sure that all these financial intermediation, the financial products, and all the activities are Sharia compliance, there should be a Sharia board, and there should be a Sharia control system. So so for example, in an Islamic bank, in an Islamic financial institution, there will be a Sharia supervisory committee that they will oversee that there is no violation of the Sharia in the activities of the Islamic bank and also their products and services. And then there will be a Sharia audit system that will also ensure that there is all the resolutions or given by the Sharia committee are implemented, and there is no violation in the transactions. And furthermore, there is in Islamic finance, there is corporate social responsibility, that the there is a compulsory alms giving or charity, which is zakat. 2.5% of the asset should be given to charity once it fulfills the haul, which is 1 year. If an asset if a business capital, for example, it has a value of more than 85 gram of gold, at the end of the year, 2.5% of it should be given to charity. So that is the beauty of Islamic finance, where uh, in the in the modern day, we are talking about social finance. Islamic finance in Islamic finance, this concept of social responsibility is rooted, as it has zakat as well, which is compulsory. Furthermore, it has wakaf and also some other voluntary sadaqah or charity. And finally, in Islamic finance, all the harmful activities are avoided. So, in Islamic finance, any kind of companies, for example, that produces weapons or that produces non-halal goods like alcohol, all of these are prohibited. And any other kind of harmful activities are prohibited in Islamic finance. So we can say that Islamic finance is quite similar with the Western concept of ethical finance. The ultimate goal is of ethical finance is to invest in corporations which are not harmful to the people, to the environment, and also to the ecosystem or to the animals, for example. So Islamic finance also has that kind of principles from the very beginning. So these are the general characteristics of Islamic finance or the financial system. Okay, so now when we learn Islamic finance, we know that Sharia is something which is the heart of Islamic finance, that gives the rules that guides the Islamic finance. So what is this Sharia is all about? Well, as we know, in the Muslim society, Sharia is not something uh, uncommon. We all know that Sharia is something that is the total of our religion that gives us the laws. Okay, so here is the definition of Sharia: is the sum total of Islamic laws which are revealed to the Prophet Muhammad sallallahu alaihi wasallam, which are recorded in the Quran, as well as deductible from the Prophet's divinely guided lifestyle. So Sharia is the source of Sharia is the Quran and the Sunnah. That we Sharia is something, is the teaching and the rules and regulations and the manners that we can learn from the Quran and Sunnah, as well as some other sources like the custom or the ijma or qiyas. So that from those sources we learn the Sharia is the totality of of the Islamic laws, is about the ethics. So the Sharia tells us how to pray, how to do the muamala or the transaction with each other, and also it covers every aspect of a human life, because the Sharia is a comprehensive. It has some basic prohibition for muamala, and then it has kept some wide door open for something we call istihad or legal deduction to give resolution on new issues. So that is the Sharia. And Sharia is something, we may wonder what is the goal of the Sharia. Actually, the Sharia is something which Allah subhanahu wa ta'ala, the lawgiver, has given to us actually to fulfill our own welfare. So Sharia, if we follow the Sharia, is not that we help Allah subhanahu wa ta'ala, rather we help ourselves. So Sharia, the ultimate goal is actually to attain the welfare or to good from us, and also to ward off or to remove evil or injury among us. For example, we can take the example of qisas, that the punishment, the law of equality. If someone kills a person without any reason, that person, the perpetrator should be killed as well by the law of qisas. So with this prescription, actually there is life, because if there is no law of qisas, people would just kill each other, and the human society will be in chaos, and it will lead to destruction very soon. So here Imam Al-Ghazali, one of the famous scholar of Sharia, he said the ultimate objective of the Sharia is the well-being of the people, which lies in safeguarding their faith, their deen, their self, their nafs, their intellect, their akal, their posterity, which is the nasal, and their wealth, property. Whatever ensures the safeguard of these five principles serves public interest and is desirable, and whatever hurts them is against public interest and its removal is desirable. So based on Imam Al-Ghazali, the ultimate objective or purpose of the Sharia to is to bring well-being to the people, and the fulfillment of the well-being is actually safeguarding the five important elements. So these are the five important elements, which is the religion, agama, deen, and then the life of the people, the protection of the life, and the protection of the lineage, which is the nasal, the future generation, and then the protection of intellect or akal, and then the protection of the property or mal. So in Islam, property it has a sanctity that we need to protect people's wealth. Therefore, the stealing is prohibited, robbery is prohibited, as well as eating somebody else's property illegally. All those prohibitions are to protect the uh, property of the people. Uh, so these are the five important essentials. So Islamic Sharia prohibited garar, riba, all these actually to fulfill the uh, this objective to protect the uh, property of people. Now, again, I would like to discuss the prohibited elements in Islamic finance to highlight these prohibitions so that it will be more clearer to understand what are the prohibitions in Islamic finance. The first prohibition is riba, which is, we can say, interest, or it can be translated as usury, but riba is something that includes interest and usury. So riba, it literally means it's an excess or increase, but technically it refers the premium that must be paid by the borrower to the lender along with the principal amount as a condition for the loan or an extension in its maturity. So if the creditor stipulates on the borrower that if there is that the borrower needs to pay some extra, and if it is contractual, then it will lead to riba. Actually, in Sharia, there are two types of riba, which is riba al-buyu and riba al-duyun. So, riba al-duyun is the low riba or interest in the borrowing and lending activities. Riba al-buyu is riba in buying and selling activities. For example, if we transact uh, gold, if we buy gold with money, so we need to transact it on the spot. But if we delay, so it will also lead to riba. Or if we exchange money for money, which we should exchange it with the same and also on the spot. If we do not do so, it will lead to riba as well. So that is the riba al buyu, the riba in sales or in buying and selling transaction. Another riba which is very easy for us to understand, is the excess that the creditor get in a borrowing and lending transaction. And then after the riba, there is a garar or uncertainty, which is any kind of ambiguity when we are doing a transaction. Let's say in the case of sale, if we want to buy something, um, uh, if the asset, the commodity that we're gonna buy, we are going to buy, if the price is not fixed, if the quantity or the quality is not fixed, or if there is ambiguity, uncertainty whether I'll be able to receive the commodity or not, so it will lead to uncertainty or garar. Nowadays there are a lot of online transactions, so the concept of garar is quite relevant to those when we sell something online, so we need to make sure there is no ambiguity in terms of the product's quality, the quantity, and as well as its features. So if there is, so it will lead to garar, or and then it will invalidate the contract. And the prohibition of garar, why the Sharia prohibits garar, is because of, to so that there is no enmity, there is no kind of cheating, as well as fighting between the buyers and sellers. And after garar, another major prohibition is al-maisir, or gambling. So maisir, from yusur, which means to get something easily. In Sharia, maisir means to get easily available wealth, or acquisition of wealth by chance, whether or not it deprives the others, right? So maisir is we get something by chance without any reward, without any compensation. Means that we get some money without working for it, or without giving any equivalent to it, and that is by luck. So that is called maisir. One of the example is like lottery. So we just get lottery. If we win the lottery, we get a lot, and without working for it, or without and then it is just based on luck. And then there is another concept in Sharia which is related to my series, called qimar. So qimar is gambling, is the game of chance that one gains at the loss of other. So the example of qimar is that a group of people, they put some money together, and then they play something, so the winner gets all the money and the others lose. So this is the example of qimar. So any kind of competition where the winner gets at the loss of the participants, so then it will lead to qimar. And also maisir is something we get something by luck, without any equivalent, or without any compensation. So this is also prohibited, and the Quran said these are prohibited, because that the gambling, it's there are a lot of issues in gambling. Sometimes people are addicted, and also gambling doesn't add anything to the economy. People they lose their focus to work, rather they try to get something. And there are even people, they have lost millions and left family, home, everything, because of the addiction to gambling. So now, after you understood the very major prohibition of Islamic finance, or prohibition of riba, garar, and maisir, let's talk about, so what's the function of Islamic financial system. So after all these functions, after all these prohibitions, can Islamic finance functions as similar to the conventional? So yes, the Islamic financial system, also similar to the conventional financial markets, they also bring together the surplus unit to the deficit units. However, they have a different mechanism. They have a mechanism of profit and loss sharing instead of interest. So they use different mechanism, but they also function. They also have the objective of bringing together the surplus fund units to the deficit units. So they also work as a saving. So in the Islamic financial system, they also work as saving. So if we have money, extra surplus money, we can go to bank and we keep it as mudaraba, or is as wadia. So it works give us savings. And then it also creates wealth. When we have surplus money, we put into a bank, or we put into a mutual fund, and that mutual fund gives us return from the investment, so it also creates wealth. At the same time, Islamic financial system also fulfills the liquidity needs. So when people need to borrow from Islamic banks, they can borrow. Or if corporations, they need to raise funds through the capital market, they can do so. Or they can also borrow from Islamic interbank money market. So Islamic financial system also gives credit or loan. So people can get loan also, or we can say financing. through Islamic banks, as well as they can also get financing through the interbank money market, or even they can also raise funds, get funds from Islamic capital market. And Islamic financial institutions also serve or the clients through giving the payment system. So we can also make payments through checks through the Islamic banks, transfer online also through Islamic banks. It is the service is the same. And also there is a risk protection. The financial institutions is also protects our money. They do when we put our money in Islamic banks, they also do uh, um, they also do their risk assessment. They also assess the credit risk or investment risk and others. So they also do because in Islam we need to share the profit and loss. We need to take risk, but at the same time also we need to uh, uh, make our best effort to mitigate the risk. So we need to find out the best investment, the investment that has a lower risk comparing with others. At the same time, if the excessive risk is prohibited in Sharia, that will lead to gambling or maisir. That happens in the case of financial markets. The people gain from speculation, excessive speculation in the market. So those are also prohibited. And Islamic financial system also works as an platform for the central bank to implement their monetary policy. So of course the conventional monetary policies all of are not in line with the Sharia, but Islamic financial in the Islamic financial system there are alternative monetary instruments that the central bank can implement through the interbank money market or through the capital market. So now we'll look into the types of Islamic financial markets. So we'll have an overview of what are Islamic financial markets as well as what are the institutions. So in Islamic financial system, we have markets, and those markets are different types based on the different or principle or different standard. So if we look into the market based on the instrument, so we can divide them into two. One is debt market, another one is equity market. So equity market is where the shares mostly are traded. So equity is a share, or in Islamic finance, there is also halal shares. So the companies that are which activities are based on Sharia, and they are not involved with interest mostly. So those are the companies they are Sharia compliant companies, and it is allowed to buy their shares, and they can be listed as halal shares in the share market. So this is the equity market. While the debt market is a market where the debt-based instruments are traded like bonds. But for Islamic financial system, there is an alternative to bond, which is sukuk, which is actually an investment certificate that gives a return to the financial to the investors. At the same time, Islamic financial markets can be divided based on the issuance at the primary market and secondary market. So the primary markets are where the initial securities are after the initial issuance. Uh, so the secondary market is So, based on the issuance, the market can be divided into a primary market and secondary market. So, primary market where the initially the securities are issued, and when those securities after their initial issuance, when they are traded, so they are traded in the secondary market. Well, based on the trading methods in the secondary market, is also can be divided into two. One is the exchange market, another one is over-the-counter market. So exchange market are where the securities are listed in an exchange where everybody can see the price and of the assets, the instruments. So like in Malaysia, we have Bursa Malaysia or Newark Stock Exchange. So all these are the exchanges where the price are known to all. But on the other hand, over-the-counter markets where the buyer and seller they meet and they negotiate the price. Usually the brokers, the representatives of the buyer and seller of the instruments, they will negotiate where the price may not be known to outside of the world. So this is the over-the-counter markets. And based on the maturity of the securities or the financial assets or the instruments that is traded in the market can be divided into two. One is money market, where the instrument has a short-term maturity. So, and financial instruments that is maturity is less than 1 year is usually in the money markets. And capital market has a maturity instrument that has a maturity is more than 1 year. So usually sukuk is one of the capital market instrument. But Islamic money market, they have instrument which are usually for short term. It can be for even for few days, overnight, or to until a few weeks or few months. The maximum usually in most of the cases is 1 year. In some cases it may have more than 1 year, but mostly it is less than 1 year. So this is the overall types of Islamic financial markets. So this is just an overview here, and inshallah we'll learn further in the subsequent weeks, inshallah. And then also I would like to give an overview of Islamic financial institutions. So Islamic financial institution also their functions also similar to the Islamic financial market is to link between the surplus unit to the deficit unit, but they work as an intermediary. While in the financial market, the surplus unit will meet directly to the deficit unit, but here the Islamic financial institutions like bank, they work an intermediary. So the depositors surplus unit, they will come to bank and they will deposit their money to the bank, and then the bank will take that money and then bank give loan, or we can say financing to the deficit unit. So the surplus unit will come to the bank, they will deposit their money to the bank, and then bank take this money and will give loan, or we can say financing to the deficit unit. So this is how the Islamic financial institution they work as an intermediary. So Islamic banks also avoid interest, and in order to avoid interest, they use various type of contracts. They use mudaraba or musharaka. So when we deposit money in Islamic bank, they use the concept of mudaraba. So mudaraba is something one party provides capital, another party provides labor or work, and then the fund is invested. If there is a profit, the profit is shared between the bank and the depositor, the client. And if there is a loss, the loss will be borne by the client, and the bank will lose its effort or the labor. So this is the mudaraba. Same, and then the musharaka is sharing profit and loss. In musharaka, both party provides capital and then it is invested, and if there is a profit, it will be shared between the two. If there is a loss, the loss will be shared as well. So in the case of Islamic bank, when we put money in Islamic bank, we deposit so usually they use the concept of mudaraba. So the bank will invest that money, and if there is a profit, so that profit will be shared between the bank and the customer. Usually the profit sharing ratio is 70 to 30%. So that is how it works. So there are different types of Islamic financial institutions, like depository institutions that are legally allowed to take deposits, like commercial banks, development financial institutions. They are actually banks, but they have a different objective, like Bank Rakyat, as well as Agrobank. And there are some credit unions, like these are the cooperatives, so they also can collect deposits. And there are some contractual institutions that they do not take deposit, but people pay them as a part of their contract. Like in Takaful, that those who join Takaful, they have to uh, transfer some amount every month, usually as a contract, or even to the pension funds. The employee and the employer need to transfer some of their part of their salary to the pension funds. And then there are some investment intermediaries, that these are the companies, they issue financial instruments like sukuk or bond, and also they invest. Like finance companies, usually they will issue sukuk or other Sharia compliant financial instrument. And mutual fund, usually they will collect funds from people, individuals. They will pool the fund and they will invest, and the return is shared among the investors. Investment banks, usually they will also they have different jobs. They sometimes help firms to issue securities or sukuk. At the same time, they also pool the fund and then they invest on behalf of their clients. So these are the different types of Islamic financial institutions. They work as an intermediary between the surplus and deficit unit. So now this is very important to understand that what are the prerequisites, what are the musts or the things should have in an Islamic financial system. For it's not only for Islamic financial system, even in the conventional system, in order for a system to be robust and to function properly, it should have a strong risk management practice. While the financial intermediaries or financial institutions, so they have a lot of trust. When people deposit their money and there is a profit and loss sharing, of course the depositors will share the profit and loss, but it doesn't mean the bank can sleep. They need to make their best efforts. They need to find the most the valuable most suitable asset, and then the asset that has a very good potential of return or the project. So they need to do their proper risk management. And there should be effective regulation. The regulation is very important for Islamic finance in order to ensure the Sharia is implemented. So they need a legal support. So the countries do not have a law for the operation of Islamic finance. They turn out with some issues on the violations of the Sharia. So, and then we need a sound corporate and Sharia governance. So, as the same like the corporate governance, conventional corporate governance in Islamic finance, we also need a sound corporate governance in order to make sure that the CEOs of the companies, or they work for the best interest of the shareholders. At the same time, in Islamic financial system, they need also Sharia governance in order to make sure that the operation, the activities, the products of the financial institutions are in line with the Sharia, and there is proper monitoring and supervision of the activities. Finally, the supportive, the legal framework, as I said in the regulation, there should be a legal framework. Most of the Muslim countries, they follow the conventional or common law or conventional law, where they in in those laws, they may not have provisions of these Islamic concepts like mudaraba or musharaka. So there should have an Islamic, there should have Islamic provisions. So there should have a legal framework. Should have, so it may have a different law for Islamic finance, or may have or the conventional law may have some special provision for Islamic financial system. And then there should be a proper regulation by the central bank to regulate and to monitor the operation of the financial system, in order to make sure that the financial intermediaries is safe, or they are working for the best interests of the investors, as well as the market. The financial markets are safe and sound for investment. So that's all on this chapter. So I have already discussed what is Islamic finance, what is the Sharia, and the major prohibitions of Sharia that makes Islamic finance different. And I have also discussed in general what are the main types of Islamic financial markets, as well as Islamic financial institutions, and what are the requisite of Islamic financial system. So this is the for further reading for on this chapter, Islamic financial system, principles and operations, the chapter 1. So with that, I thank you for your attention. And if you have any question, you can put your question in the comment section, or you can text me for your question. So thank you. Assalamu alaikum wa rahmatullahi wa barakatuh.